Welcome everyone to a special presentation at Story Trading. We have Chris Hampton and Rob Bach together here with me, Ben Rabizadeh at Story Trading, a special edition on anatomy of a gamma squeeze. We're going to be reviewing GameStop, AMC, and DNN. So quick overview about who we are, Story Trading. We're an investor community where we work together to beat Wall Street insiders at their own game through crowdsourced collaboration, which facilitates an understanding of the story behind the trade. And we also get access to management presentations and other presentations from analysts and money managers with our VIP program. We are developing an app upcoming, which will make all this even easier. So stay tuned to learn how to be first online to that invite list. Quick disclaimer, Story Trading is not an investment advisor. None of our presenters are investment advisors unless they say otherwise. Investing in securities involves significant risk of loss. And this presentation is being recorded and it will be available on our social media site. So first, before we get started with the presentation, I want to review some of our performance for what we call our VIP picks. You can also get here by going to storytrading.com, clicking on performance up there in the top right. And as far as our presenters today, I want to, since we are talking about a uranium stock, I want to highlight that we got interested in uranium back on February 7th when our Florian Bushek from our community presented Paladin. That stock's up 31% already. And subsequent to that, Rob Mock presented DNN on February 21st. It's up 2.25% already. We also tally performance by presenter, and you can see here are my two colleagues here tonight. Chris Hampton, he has 3 picks, averaging 75% over 154 days, which is an annualized 180% return. And Rob Mock, 4 picks over 111 days. We look at this annualized number to give you a sense of our presenter's timing. It's not to say that if you hold those stocks for a full year that will be a return, but it's indicative of how well they do with their timing. So I also want to point out these past presentations I pointed out on DNN and Paladin. If you go to youtube.com, just type in Story Trading and subscribe to our channel here, you'll be able to see these presentations. DNN is right there and Paladin's over here from last week. All right, so with that, I want to get started. Anatomy of a gamma squeeze. I'm going to have Chris Hampton take the lead on this conversation. He is a resident expert in our community on short squeezes and gamma squeezes. And Rob and I will jump in and contribute to the conversation as we go through this. Thank you. Chris, go ahead.
I didn't know I was a resident expert, but I'm happy to take the lead on this. So where are we going to start? Short squeeze. Easy enough. Shorting is when you sell a stock before you buy it, you borrow it, you sell it, and you hope the stock goes down. In the case of GME, quite a few people did this at once. I think GME was over 100% shorted, something like 130%.
Yeah, about 140%. Yeah.
Yeah, and they got called on that. There was a lot of people talking about moving on GME and Reddit pretty famously, and the stock famously spiked. And in the course of that, people that shorted GME at 10 or below saw the stock go up to 600, it was, and potentially 10,000% loss returns. 10,000% losses, or is that up 100 times? Yeah, 10,000% loss if they held through it. But most likely they were forced to buy back in the course of that spike, which is what causes a short squeeze. It's the forced buying in by short sellers.
Excellent. So, it's pretty common. I think people know and have heard about what a short squeeze is. And I don't know if there's anything else, Rob, you want to add about that? But, what was really interesting to me is a discussion of gamma squeezes. I've never heard of that term before, and it's been talked about a lot. I've learned a lot from Chris about what a gamma squeeze is. So is there anything else, Rob, you wanted to add on short squeezes before we move to gamma squeeze?
Yeah, I can give a little color on short squeeze. One of the interesting things is as the GME price went up, some shorts were leaving the trade and getting out of it, and other shorts kept jumping up. Because you would think as the price got higher and higher, the shorts would kind of bail and get out of the trade and be like, this isn't worth it. But some shorts stayed in hoping for either a future drop, and some shorts got out and others jumped in. But leading into the gamma squeeze, shorting one share is you pay the full price for that share and it goes down. So it's more of a 1-to-1 ratio. And the gamma squeeze involves call options. So it's less of you could actually gain leverage for the squeeze. Now we'll talk about the gamma squeeze.
So when you buy an out of the money call option, it's most often the market maker that is taking the other side of the trade. You'll buy at the ask or somewhere, and the market maker will sell you a call and go short that call himself. Market makers have to hedge against losses. They want to protect themselves. So as the stock moves up, they'll buy the common shares, the underlying security, a portion of them. Basically, when you buy a call, there's the delta, one of the Greeks, and that's the amount the call moves up if the stock moves up a point. That delta number is the portion of the share that the market maker will need to buy if the stock goes up a point. So you buy 100 call options, the market maker might have to buy 100 shares if the underlying stock goes up a point. And then because the delta increases as the stock gets closer to your strike price, he might have to buy 200 shares when it goes up the next point, and 300 shares, and so on. So that out of the money call option, as it gets closer to being in the money, it forces the market maker to do more and more dramatic buying to protect himself against losses.
Sure, and if I can add a little bit of color to that, Chris, I can vouch for the fact that this is actually happening mechanically in the market because I experienced it myself before I ever knew what you explained to me. About 2 years ago, I was heavily investing in a stock called SMSI, Smith Micro. Pull up the chart here. This was when the stock was below $2. Let's go in the 6 months. So let me just go back to a 3-year view here. So down here, when the stock was between $1 and $2, I was heavily investing primarily in call options rather than the common stock. And a lot of the call options I was buying were either in the money or slightly out of the money. And I noticed when I was placing these orders, I would be watching level 2, both for the call options that I was trying to buy or sell, and I was watching the stock. And the moment I would put in, I was doing big orders of several hundred contracts. So let's say I'm trying to buy 200 contracts of SMSI at a $2 strike, and the stock was around $2. I would notice that instantly there would be a huge bid correlating for the common stock when I was trying to buy the stock options. And the same thing happened when I was trying to sell it. You'd see a huge ask pop up. So it took me a while, and I started correlating in my mind that, hey, these must be the market makers that are selling these and trading these call options to me, and they're being forced to then buy the underlying in the open market. And I was only able to observe this because the volume in SMSI is relatively very low. So I could see all this happening in real time. And I remember collaborating with people in the story trading chats in the community at that time. Actually, I was describing that this was happening, and they doubted me. Oh, no, that's not happening. You're not having an impact on the actual stock price. That's ridiculous. But I was, and it's crazy that people can control the underlying, or impact, I should say, impact the underlying stock action based on these trades you're doing with the call options. So absolutely, Chris, what you're saying is 100% true.
You were probably the majority of the market in call options for SMC.
I was almost my entire position was when the stock was around $2. I decided to basically sell all of my common shares and get entirely in $1 calls, and so I could double my position. Basically, I had leverage. And I wasn't really paying a premium for that either. Maybe sometimes I had to pay a 5-cent premium. And then as the stock started going up and I made some money and took some profits, I said, let me get a little risky. And if the stock was at like 2 or 225, I was going for a little bit of 250 calls. So I had a lot of experience over like a 12-month span trading the call options in the open market and seeing the impact that had on the underlying. So that was a very educational experience for me.
Yeah, it sounds like it.
Yeah.
The market makers probably got to know you pretty well. How's that Ben guy again? Damn
it. So,
do we want to jump to the AMC chart?
Well, I wanted to, before we go there, if we can look at some of these metrics for GME and see, like, to what extent was this are you finished talking about explaining the gamma squeeze? I think you just only talked so far about the mechanics of what the market maker has to do, but what happens when the price is now approaching, I think you said it, but as the price approaches the strike price, if these market makers didn't cover themselves enough at lower prices, they have to buy more and more of that stock. Yeah. I think you were starting to mention that.
When it hits the strike price, they have to have one common share for every option you hold. Right. The delta rises to 1.
So looking at the GME chart here, does that tell you a story of what may have happened here? Was this a short squeeze or was it a gamma squeeze or both?
Disaster, both. I mean, there were more shorts outstanding than there were shares available. I think there were several times more call options outstanding than there were shares outstanding. I'm just not sure if it has resolved yet.
What do these numbers tell us? The open interest on the calls here, we have 400. It looks like 500,000. Let's call it between 400,000 and 500,000 open interest on the calls, which by my math represents, if they were all in the money, represents 50 million shares that the MMs would have to own in order to cover themselves. But does that math work? How does that compare to the put open interest, which is very high for GameStop here?
Well, the gamma squeeze works in the same way for puts. It's an accelerator. The market makers are short gamma in both cases. So a gamma squeeze works on the way down as well. In both cases, the market makers have to buy more shares as the stock rises, and as the stock falls, they'll sell an increasing number of shares. So, spikes up, spikes down.
So I was involved in GameStop and I saw it playing out, and I played puts and calls on GameStop, and going up into the increase in GameStop, you had the short squeeze, and you had high call volume before the put volume started to spike, and that caused the gamma squeeze along with the short squeeze at the same time. And usually the puts would push the price down. But since the share price of GameStop was flying so high, it kept putting all the puts out of the money and didn't force any selling until it hit its peak. And then all of a sudden the puts caused an accelerated downtrend all the way down to about $40. And I played commons on the way up and puts on the way down. Another thing about call options is a call option says if this stock reaches this strike price, you have the option to buy 100 shares. So one call option represents 100 shares, and that's why the market makers have to own those shares as it gets closer to that strike price, so they could sell you the shares. And the interesting thing about way out of the money call options is they're extremely cheap. So they give you a lot of leverage, but they only give you that leverage if the price of the stock goes really high. So most call options expire worthless and are not a very good investment. But if you find a situation where a stock is going to skyrocket for some reason or another, all of a sudden you can make a lot of money, possibly off call options. But most of the time, it's a good way to lose money.
Yeah, absolutely. Just want to point out that this 50 million shares that this open interest is representing is more than the 45 million float on GME, right? So the short interest,
150 million calls or 15?
50, well, 500,000 would be 50 million.
50 million.
So if they all were in the money, of course, but the float is only 45 million. So to me, that's another way to think of when you talk about the short position. Let's say right now, I think it's 60% last report on GME, but you know, the open interest on the calls is over 100%. It's not a similar situation as you had with the shorts when it was over 100%. Yeah. So I mean, if these approach
every the whole portion of the open interest that expires in the money,
exactly,
they're going to call the shares.
Yeah,
they're going to take the shares.
All right, so let's move on to AMC and see what happened there, if that was the same story or not. So, Chris, what do you see in the chart over here on AMC? Got the implied volatility there as well for you.
I didn't trade GME or AMC. I'm in a little AMC right now just for fun. I watched this happen. I didn't have a lot of fundamental faith in either of those two. You know, I've just never seen anything like that right there. What is that candle? The hanging chat.
Yeah, this one up here.
It gapped from 5. I obviously have a smaller screen than you do, so this is pretty small type, but it looks like it went from 5 from 5 to 20.
Yeah, it went from about 5 to 20.
Late in January.
Yeah, well, it was 265. It was even like $2 a few days before that. Yeah.
Yeah, and I'm guessing there wasn't some tremendous fundamental change in AMC that justified a 400% increase in valuation. So, I mean, that's how do you explain that? That's not consistent trading. That happened after hours when options don't trade on AMC. I cannot explain that gap. You guys want to try? I mean, short squeeze what happened.
So I was involved in AMC from $5 to 20, and I played commons on the way up and puts on the way down again. It was more of a sentiment trade. The AMC hit the younger audience and people, and it was also 3rd or 4th for highest short interest. So you had a gamma squeeze with really high call options, higher than you saw in GameStop and much higher than the puts. And then you also had the high short interest along with the sentiment and the fact that AMC was well known. It wasn't driven by Wall Street bets. It was more, I saw Twitter and social media and other influencers driving this one, but it eventually became very popular on Wall Street bets. And that drove it up to about 20 very quickly.
Yeah.
And then
instantaneously.
So was there,
yeah.
Looking at the open interest on the calls, do you see anything in here, any clues here that this was a gamma squeeze, or was it just that sentiment play?
No, they started buying up the calls pretty aggressively. I'm assuming buying up the common simultaneously and likely starting before. And I guess they just locked up the entire float somehow. And there were just no shares available.
The interesting thing here is GameStop had the 140% short interest. This had 37% or much lower short interest. So the gamma squeeze plus short interest was enough for this push up. It didn't go from like 4 to 400 like GameStop did, but anyone who was involved in these calls could have made a lot of money. Admittedly, I had calls where I made like a 50,000 profit. And if I waited another week, I would have made 100 times.
That was incredible.
I sold early.
I've been short stocks that have gapped up in the morning like 20%. It's a really lousy way to start the day.
Yeah. And another interesting thing is look at the second run. There's much higher call interest, and it's a shorter run, but it's more of a gamma squeeze.
And this open interest, by the way, on the calls represents the entire float or more. I have the numbers I'm looking at as 136 million on the float. So at 1.5 million, that's 150 million shares.
It's
so that they're selling.
That AMC is still warming up.
Yeah. They're selling more, and you bring this up a lot in our community, Rob, that it seems that the mechanics of Wall Street allows these MMs to sell more call contracts than exist in terms of the correlating shares. Again, at 1.5 million.
Be doing that. That's the other piece of AMC and GameStop. They went way past their fundamental or actual value on hype. AMC's been beat way down because of COVID, and all the theaters are shut down. It's losing money and like struggling to survive. The CEO is doing a good job of keeping the company afloat until things reopen. And I think some of the theaters just opened in New York City, and that was a catalyst for this second run, in addition to the gamma squeeze. And same thing with GameStop. Yeah, it's more valuable if it switches over to e-commerce, but it was given its maybe value 50 years from now today. And you usually don't see that in stocks. And that's under the best possible conditions. Neither of these companies are going to be the next Tesla.
All the time. This looks like a penny stock chart.
Yeah.
All right, guys. Well, that brings us to the stock that's the star of the show, maybe, that we want to talk about, which is DNN. Denison Mines. Before we get into this, I want to disclose, first of all, I don't have a position in GME or AMC, but I do have a long position in DNN, both the common shares and the options. I don't know if there are any disclosures you guys need to make on that.
Yeah, I have commons and calls and DNN.
Yeah, I have commons and I'm short puts at the moment.
Okay, great. So with that out of the way, DNN, again, I just want to remind you, was we got into these uranium stocks after, again, Florian Bushek introduced the uranium. There's a very strong bull thesis for uranium, strong fundamentals that are pinning the movements in all these uranium stocks the last couple of weeks. At Story Trading, we look at stocks that have strong fundamentals as well. We look at the 4 pillars. Those 4 pillars are fundamentals, catalysts, sentiment, and technicals. So we try to avoid stocks that don't have that fundamental pillar, which is why, the 3 of us weren't big into AMC and GameStop. But DNN is a different story because it's got the fundamentals, we think, based on our research, right, that it could be a good long-term holding. It could be an undervalued company. And what's interesting is you have that fundamental pillar, but you also may have these technical indicators in terms of the calls. Well, let's just jump into it, Chris. What do you see in terms of this call activity here that may be interesting to you?
Well, I was in DNN for a while, and it was on February 11th. There had been really heavy share buying going on, 10 or 20 times normal volume. And then normal call volume for DNN used to be like 100 contracts a day. It started building up to 1,000 contracts. Then all of a sudden, on February 11th, they just started pounding it. Hundreds of thousands of contracts going through and tons of common share buying. I was watching the stock, and what happened is I saw the implied volatility on the call options spike up to 600, and the call buyers just kept hitting the ask, even at a 600 IV. and the huge premiums that go along with that. And that's when I tripled my position. I think that was around $1.10.
Interesting. But by the way,
yeah.
Chris, you sent me some charts earlier. If you want me to refer to any of those, just let me know. I have them up in the PowerPoint available for you.
Yeah, those would be more useful than this, perhaps.
There we go. That's your first one.
That's the intraday IV and call volume for today. Do you have the historical one? That's it. There we go. Those are the big spikes in calls. And what's interesting, there wasn't any corresponding put selling in this one, which doesn't matter that much for the gamma squeeze, but there's just a huge call skew on this, and that's bullish.
And when you say huge, I think it was about 250K in calls, or 250,000 calls.
Yeah. And like hundreds.
And it looks like a lot of them went for about 25 cents. Like the cost is close to like 6 million. Yeah. And then as the stock ran, they got up to like 30 or 35 cents, which is like $10 million in calls.
Yeah, and this was when the stock needed a 100% gain in a week for those calls to be in the money. But people were just pounding the ask at 30 cents. And what happens when the IV spikes, the gamma squeeze accelerates, it gets pumped to a different level. Call it a Vanna squeeze, because when the IV increases, the MMs do that. They probably hope to discourage some of the call volume. It didn't work. And what happens when that IV goes up is the delta increases. And so all the shares that they are already delta hedging, they have to go back and increase their delta hedging for each of those shares that were bought days before. And that's really when the stock took off.
So let me see if I understand this. Some of this is a little over my head, Chris, but are you saying that even if these call options are out of the money, and maybe appreciably out of the money, but because the delta is higher, they would have to buy more stock than they ordinarily would? They don't really have to wait for it to reach the strike price?
Well, there's a delta on every option, no matter how out of the money. I think it was like 10 cents, but it increases as you get closer. The call price will increase more for the same movement as the common stock gets closer to the strike price. But the other factor that influences the change in the price of the option is the implied volatility, or what we can call premium. Options are more expensive for a highly volatile stock than a stock that trades in a narrow range. And on February 10th, implied volatility, you see implied volatility is normal for a regular big cap, like 60. Sometimes you see 100. I don't know if I've ever seen 600 before. That was really wild.
Yeah, it was a massive spike in call volume and massive spike in common volume at the same time.
Yeah, and it's crazy to buy calls that expire in a week that require 100% appreciation in the stock price. And it wasn't like there was an earnings call or any potential fundamental event that could cause. It was purely gamma squeeze.
So
those, right, February 19th. Okay, those were but there's still, so we're looking at March. This open end. So even though those expired, we're still increasing, and this looks like we're at a record high right now in the
they were hitting the Marches, and they're still. It's not at nearly the rate it was. If you go to the charts I sent, the IV has been dropping until today. As the stock has dropped and based, but it looks to have re-entered an uptrend. And I would not be at all surprised if we see the call volume come in again.
Yeah.
It's still very elevated.
So
there's a lot of open interest.
So what does all this say about the possibility of a move similar to what happened with GameStop or AMC? Is there a parallel here? Is there a possibility we could see?
It's a different situation. There's not really an appreciable amount of shorts in DNN, but it's a different kind of short squeeze. It's a supply squeeze on utilities and nuclear power reactors. Since the last bull market in uranium in 2007, after that, there was a large oversupply. They overbuilt. Then that disaster in Japan, they started selling their inventory. But since, I believe, 2015, uranium mines have been producing less uranium than reactors are using. So they've just been drawing down inventory. And a lot of people believe they've hit the end of it here. And, you know, mines take a while to start up. It's not like, oh, we ran out of uranium. You know, can you guys turn on lights and get us some tomorrow? It takes a year. And you can't turn off a uranium reactor. You can't, turn off the lights there and go out to lunch. You have to keep running it, keep cooling it. So it's going to be a big predicament. And when uranium runs, it just rips your face off. It'll be a dynamic commodity and a dynamic bull market if that's what's happening here. And it has to happen. After every bear market, there's going to be a bull. And there's chronic undersupply. It's looks like it's happening now, but if it doesn't happen now, it's going to happen soon.
And thank you for that reminder on the fundamentals. Again, I want to remind people we have two presentations. Rob's specifically on DNN, where he goes deep into the fundamentals. He looks at the sentiment, the catalysts as well, and the technicals. And then the other presentation on uranium in general and Paladin from Florian Bushek. Rob, what's your take based on what you're seeing on the chart here and this open interest? And I think there's an earnings report this week. What do you foresee for the stock from here?
So a little background along with what Christopher just stated, where we have an extreme supply shortage primarily because of like COVID mine shutdowns and increasingly higher demand because of demand for clean energy. Nuclear actually provides very clean and consistent energy, and solar and wind are actually low consistent energy. So you actually want to team up nuclear with wind and solar, and that's going to be probably done around the world. Currently, spot price of uranium is around $30. It spiked up to $140 before when there was a supply shortage. And DNN, people say, have possibly a currently value around like $2. If the price of uranium spiked up to $150 to $180, held there and had a higher average, it could push up DNN to a much higher future value. And the mines for DNN won't be mining until 2023 and that's when uranium will be at its highest value. So this company could have a much higher like theoretical fundamental value. It's not for sure, but it's more for sure than possibly GameStop and AMC. And that's why we like this stock. So I got involved in this as soon as I saw the high call interest combined with the high volume of buying. The interesting thing that I saw was very, very high buying of commons, but it wasn't pushing the price up an appreciable amount. So that tells me it was controlled accumulation by hedge funds and smart retail investors. As long in addition, that giant call buying was also kind of a smart purchase. So everyone looks at this and they're like, oh, it ran up to 180 and it fell back down and it's done. Not in this case. I think it was a massive accumulation before the bigger run. And some of my evidence for that is the call options. When it spiked to 180, you should have seen some of those call options selling off. And then as the price was going down, you should see some of those calls selling off. they're not selling off. And the other thing I noticed was they still had to accumulate a following. Currently, they went from about like 8 to 20,000 watchers on StockTwits. Wall Street Bets was trending them at like number 22. And a lot of people lost interest in the past few weeks. But now...
A Reddit board started Uranium Squeeze on, I think, February 5th and got like 2,000 members within 4 days.
Yeah, now I think they're at like 3,000.
Yeah.
They have a lot of good articles, and they were focused on DNN. StockTwits, more followers on DNN. Wall Street Bets trending on DNN. So it seems to be the stock of focus. But as of today, with new articles coming out on uranium and the stocks running again, we're trending on Wall Street Bets again. And there's a lot more attention on like social media. So I think smart money bought in and kind of built up their positions.
Yeah, that's exactly right.
The interesting thing is today was a very low volume, like 20 million, which is a little higher for the stock, but nowhere near the volume we were seeing before. But we're seeing appreciable gains on low volume. So I'm thinking smart money wants to buy loads of calls and shares without pushing up the stock appreciably, pushing it up on, not pushing it up much on high volume. And then all of a sudden there's a lack of interest because they finish buying. And then all of a sudden, a few weeks later, the stock starts to move up slowly on low volume. And then the stock will get tons of attention from all social media. It'll be on possibly all the articles. It'll hit Wall Street Bets. Everyone will be buying, and then the smart money could sell at a much higher price on high volume and make lots of money. But
a GME took months to play out. They were buying calls, building that base, and buying commons, most of all, for a long time before it spiked. And I think that's what happened in DNN. Those 1 week out 250 calls were just so crazy. I think it's people that had large common positions, and they bought those calls. Those calls took one for the team. They just bought those calls for the sake of the stock appreciation.
Yeah, when I saw those calls being bought, the February, I jumped to the March because I think someone saw all the March being bought and the April, and they're like, let me jump into the Februaries. But it was about 50,000 on the February, but March was 250,000. So the big money was targeting March, which is... I think there's a fireside chat this week, and the earnings report is possibly this week or in the next few weeks.
Something that's the offering that was the prior week, 25 million, and apparently initially it was 8 times oversubscribed, and that's all institutions, and that's $200 million that couldn't get into the offering, that wants into DNN and knows there's not going to be another offering for a while, and probably well into the uranium bull market when it's going to be a lot higher. So those institutions have to buy common stock in the public market like the rest of us.
Yep.
And, all that volume, it wasn't Reddit. It was those institutions as well. Maybe people that knew that was happening and were pushing the stock price. It was explosive.
Yeah, and just to visualize what you said there about the March and April calls versus the February, this little drop here was the February options expiring. So it had very minimal impact in the OI. These are long holders. Yeah, these are long holders in the March and April. And I do want to go back to the fundamentals real quick because from the collaboration we've been doing in the rooms, we're looking at what I'm hearing is a $1.50 to $2 is fair valuation today, based on today's uranium price, right? Based on today's uranium price.
I mean, it seems like the market is pretty much assuming a $50 uranium price right now. And Denison is definitely at least $2 at $50.
Oh, yeah.
Yeah, they say when Cameco and the other companies start to write their first contracts, they'll be starting at $50 easy. And the different uranium providers are not writing contracts because they're waiting for the nuclear companies to get more desperate so they could charge more for their contracts. But that's causing a major supply squeeze because they're not even running the mines. Supplies are going to get very scarily low.
I think Cameco is buying off the spot market to fulfill their contracts. They're not pulling it out of the ground. They're buying it.
Yeah, they're buying it from others to fulfill their current contract.
I think you guys just made me more bullish. I think I have a relatively small allocation of common shares in my portfolio, and I might just go out tomorrow and increase that allocation. So always helpful when we have these conversations.
So
there's way too many things colliding at once. There's clean energy. There's a supply shortage. There's a COVID shortage. There's gonna be higher demand.
But what's happening at Denison? It's not directly gonna affect the overall uranium bull market. But maybe it can. I mean, us retailers, we can't buy uranium in the spot market, but commodity traders can. And as they build positions, they get good positions of stocks like DNN, then they are going to go out and they're going to start buying up uranium to, pop the price and squeeze that demand a little bit. And as Denison gets a higher stock price, it's going to be a leader in this bull, and it can go out and maybe use that higher stock price to buy up the juniors.
Yeah, that's one of the theories I had was Denison could possibly be behind this push. Because if it spikes up and raises money at a higher valuation, it could buy cheaper uranium companies before the spot price runs up, and then it has way more assets that are going to increase in value, and it's perfect timing for that.
This is great. This is how I like a stock with good fundamentals, so that you have conviction, so you don't get scared when the stock price goes down, right? With a lot of these stocks that are being promoted around the internet that don't have great fundamentals, it's very easy to get shaken out when the stock drops and you can lose money. Here, because of the fundamental underpinnings, when the stock drops, not only do you have no worries, but you may even add more when it drops. So this is a great story stock. Again, I want to remind people I'm not a certified financial advisor. I'm not giving investment advice. This is for entertainment purposes only. But pretty compelling thesis you guys put out there. Appreciate that.
I have one thing on the AMC chart I should mention that people should look for. Can you go back to that?
Did he mention your long AMC now, or did I?
So I'm out of AMC and out of GameStop completely.
Oh, okay. All right. That's the AMC chart.
So if you look at the second run of AMC, you see like high call options. It looks like retail traders are learning that they can make lots of money on out of the money call options, but only if a stock gets pushed up. And I've been watching the stocks that are popular on Wall Street Bets, like on a website called swaggystocks.com. It shows the most popular tickers. DNN is currently number 23. I think it just hit it again. And one of the interesting things on AMC is the call spiked up on that second. Yeah, if you could zoom in on the second spike of AMC, you see much higher calls than the first spike of AMC. People are learning that you could make a lot of money on OTM calls. And I guess just to tell everyone, on DNN, I'm mostly commons because calls are risky, but it looks like people are learning that out of the money calls, you can make pretty good money on if a stock runs way up. And the other thing about Wall Street Bets is they target companies with a market cap of $1 billion or over. And what's the current market cap of DNN, then?
$1 billion.
Is it? It's right around there.
I think it's about 845.
Let's see. Yeah, I'm seeing 882 according to the app I'm looking at right now.
Yeah, it went up a bit.
But I don't know. They did have the offering lately, so that may not be reflected in a lot of fintech apps.
So one of the things to watch out for is as soon as I was watching last time, as soon as DNN hit $1 billion market cap, all of a sudden it got 60 to 80 messages on Wall Street Bets, and it was gaining popularity. And then when it fell under about $1.45, where it hits that 1 billion mark, they didn't discuss it anymore. So if this stock hits $1.45 again and becomes popularized on Wall Street Bets, it has very cheap, out of the money call options. It has great catalysts. It has a great story. It's already popular in a lot of circles. It could move up the ranks to be one of the top tickers on Wall Street Bets, and that would cause more call buying and a large possible run. But to do that, it has to hit 145, and that's something to watch out for.
Awesome. Thank you again, Rob, for that. Thank you, Chris. I think we're going to wrap it up here. I think we're coming up close to an hour. Before we do that, I just want to point out future events. This one's a recording specifically for social media, but we do Zoom events all the time for a community, for our VIP community. Some events are free and some events you got to be a VIP member. If you hop on over to storytrading.com and click on events right there, what you'll see is all of our event listings. Actually, Wednesday, we got Jonah Lupton of Social Capital. That's a free event. The rest of these events scheduled so far are all VIP events. We got Richard Chu this coming Sunday night, Mark Holmes next Wednesday, and we got a new pick from a presenter in our community on March 14th. So hop on over to our website to take a look at what's coming up. And that'll be all. Thank you, Chris. Thank you, Rob.
Thank you, Ben.
Good night.
Have a good night.
Good night.